Can you see how we got to the end result? Okay, so we apply this now to the graph. So we can see we're buying the shares at basically $30. We're buying a $30 put. So if the share price goes down, the trade's protected. If the share price goes up, it has to go to $32.80, which is the top of the blue section. Everyone sees the blue section there? Okay. Now, once it gets above the blue section, now we're into profit. All right, net profit now, because we've paid back all the cost of puts, and we have profit. But now it's leveraged 10 to 1. So every 1% the price of oil goes up in the green section is a 10% profit on our CFD margin. Sound good? Okay. Now, looking at the blue section, how quickly could the share price get above the blue section? In a day, couldn't it? In a week or so. So you can see here the cost of the insurance is very small compared to the protection that it gives you. And let me ask you, how many people here would be totally comfortable to do this trade so long as you have the put option in place? Excellent. How many people here would do the trade if they didn't have the put option in place? Nobody. See, that's a big difference. See, success doesn't come from profit. Success comes from protecting your money. Once you protect your money, right, once you eliminate risk, all you have left is what? Profit. But if you don't eliminate the risk, you could have a huge loss. Make sense? Okay. Let me put it another way. If you didn't buy the put option, the only extra profit you could make is the blue section. But if the price goes down, you could lose multiple times your money. Who here thinks it would be totally stupid to not buy the put option, considering that you're only giving up the blue section of profit? In other words, who'd be quite happy to give up the blue section of profit in order to have the huge downside protection of the red zone and still have all the profit potential of the green zone? Who thinks that makes total sense? And frankly, you'd be a moron not to do it. Is that fair to say? So why don't people buy put options to hedge their CFDs? They just didn't know how, right? They just didn't know how they could. Why didn't they know how? No one told them. How long has it been around for? Years. I've been teaching this particular strategy for 6 years now. All right? It's not new. You've just heard about it for the first time. All right. So here we purchased a trade on oil. We bought a stock that mirrors the oil price. All right? We've put in place our protection for the next 9 months. Right, the price of oil has to go up 9.1% to break even, and then we make a profit after that. The price can now go where? Up, down, or sideways. 3 different ways. So let's say it goes up, down, or sideways. Okay? The first one, let's say it goes up. Now, if the price of oil went up, let's say the price of oil goes up to $85 a barrel. If the price of oil gets up to about $85 a barrel, then the price of the shares is going to be up near $50 a share, because the shares run about $30, $35 behind the oil price. Okay, remember before the price was at $50 a barrel and the shares were at 30? So if the oil gets to 85, the shares will be up around $50 a share. Make sense? Cool. So, looking at the graph, is it possible that the share price could get back to $50? It was at 120 last year. Absolutely, right? So I'm only asking the oil price to get back to about half of where it was last year, let alone all the way back where it was last year. Okay? Now, if it did that and the share price went up to $50, okay, there'd be a profit then of $17.20 per share, which is a return of $27,520 on profit on the oil trade. Now, take off the interest, would leave a net profit then of $26,800. That's only if the oil price gets back to half of where it was last year. Now, who here could afford to use $26,800 to pay off their petrol bill for the rest of their entire life? Right? And how long would it take to actually buy the CFDs? Seconds. And how long would it take to buy the put option? Seconds. So a trade that would take you less than a minute to place, and you'd hold it for a period of time, doing nothing per day, just holding it. If the price of oil gets back to half of where it was last year, you'd make enough profit from that trade if you allocated $10,000. Right? You might allocate less or more, right? To pay off your petrol bill virtually for your life. Who thinks it's a fantastic looking opportunity? And who thinks the oil price is going to go back up? I mean, come on, give me a break. Show me something better. Now, the stock price could also what though? Fall. Now, can the oil price go to zero? No, it's impossible for oil to go to zero because there's always a demand. But could it fall? Yeah, sure. Okay, it could fall. So let's say the share price does actually go down. All right, if the share price fell to, say, $20, we would lose $10.01 per share because we bought them for $30.01, right? So we'd lose $16,016. If you had no put options, that would be a loss of 334% of your margin. And how would that feel? Lose 3 times more than you put in. Ow. Right? But how would you feel if you had the put option? Right? And that's the feeling you want to have, right? Whenever you feel like, while you're trading, okay, that's when you know you're doing it right. All right? If you have the feeling of, oh God, that's when you know you're doing it. Who has that feeling when they normally trade the market? Who has that, oh God, type feeling, okay? Do you think Warren Buffett goes to work feeling, oh God? No, Warren Buffett is, that's a professional trader, okay? That's an amateur trader. All right. Now, if you've got the put options, the share price has gone down, but what are the puts now worth? The puts are now worth a guaranteed minimum of $10 per share. Why? Because you have a $30 strike price. The shares are now at $20. Just the intrinsic value of those put options, guaranteed, is worth $10 a share. Not even counting the time value that's remaining. Who understands put options and understands what I'm saying? Agrees with what I'm saying, right? So guaranteed, those puts are now worth $10 per share, which you can immediately sell the puts, getting $21,000 cash minimum. That more than offsets the loss on the stock, leaving a surplus of $4,984. Why did we get a surplus? Why have the value of the puts gone up more than the share price has gone down? Because we bought the extra puts. Who said that? Was that you? Well done, mate. Well done. All right. Team one, go team one. All right. Now, yeah, exactly what he said, right? Because we bought the extra puts. If we hadn't bought the extra puts, then the profit on the puts would only offset the loss on the stock. Because we bought the extra puts, they've gone up in value as the share price went down, which has given us a surplus of $4,984. Now, what do we use the surplus for? To pay us back the cost of buying the puts in the first place, right, which is $4,515. So we actually end up with a small profit to pay off the interest. So the share price has gone down. We haven't made a profit, but we've got all the money back. Make sense? Okay, is that cool? You haven't made a profit, you get your money back, all right? Or the share price could go where? Worst case scenario, the share price goes where? Sideways. Now, why is this the worst case scenario? We're not losing any money on the shares, but we're running out of what? Time on the put option. That's right. Now, when Simon buys his car, right, what he's really buying is he's buying insurance. He's buying protection for a period of time. Make sense? When he buys his insurance. Okay, eventually your time's going to run out. You've got to buy more insurance, correct? It's the same thing here. We're buying protection for a period of time. Now, what we find with put options is that about 2-3 weeks before they expire, they lose about 2/3 of their value. So just in the last 3 weeks of their life, they lose 2/3 of their value. So we're going to buy put options back when we've got about 9 months worth of time. Now, if the share price goes dead sideways, when we have about 1 or 2 months left to go, what do you do with the put option? You sell it, right? You sell the put option. Why do you sell the put option? What's that? Well, you don't make all your money back, but you can sell the put option and get a big chunk of it back, right? Who here has ever bought a car, insured the car, you then sell the car before the car insurance expires? Who's ever done that before, right? And you ring the car insurance company, what do? They give you a check for the remaining time that you didn't use, correct? It's the exact same thing here. We're just selling our option before it expires. If the share price has gone sideways, we're going to get back about 60% of what we paid to buy the put, which means we'll lose about 40% of what we paid to buy the put. So we're going to have a loss in this case of about $1,800. Now, how much did we allocate on the whole trade? $10,000, right. So we're going to lose about 18%. So understand this. If the share price goes up, we get our money back and a big profit. If the share price goes down, we get our money back, no profit. Okay? If the share price goes dead sideways, and what do I mean by sideways? I mean sideways. Like it literally has to be within, because if it goes to the top of the blue section, you get your money back. It literally has to be within about 3 or 4% of the original purchase price 9 months later, or 7 or 8 months later, and we lose about 18% of the overall investment. Who's pretty comfortable with that? Okay, and what's the likelihood of oil, which went up 1,300%, down 77%, to now go sideways in the most volatile stock market in the history of the world for the next 7 months? Is that likely to happen? No. It's far more likely it's going to do what? Go up or down, right? It's not likely to go sideways. Could it happen? Yes, but is it likely? No. But we have to talk about it in case it did, all right? Now, what would you actually do if that actually did happen and went sideways? What would you do? You'd sell the put, but do you have to sell the oil? No, you can sell it, keep the oil, and do what? Buy another put with more time, stay on the trade. If the price recovers, you make all that 18% back and a profit and go on. Make sense? So you don't have to sell the oil. All right? So you simply hold the trade, buy another put, or if you wanted to, just get out of the trade altogether. So what actually happened? What actually happened on this trade? Let's have a look. Okay, so we entered the trade, and you can see the blue section now. I've zoomed in a little bit right now. Okay, so we want to get to the top of the blue section and then into the what? Into the green section. Okay, so here we're entering the trade. So which way do you want the price to go? Up, okay. Over the first few days, what happened? The price went, oh, it went down. But how do you feel? Yeah, fine, you get the put option in place, right? Everything's good, all right. Where do you want the price to go now? Up. Okay, so within a month, the price is now at the top of the blue section. So we've only just now broken even. We haven't made a profit yet, but we're just breaking even. You can now close down and get all your money back. Who's comfortable at this point? All right, very good, okay. So who would close out now? There's no point to close out now, right? You've only just made your profit, correct? So which way do you want the price to go now? Up. Now, of course, remember, this is a U.S. stock, okay? It mirrors the global oil price, but it's traded on the U.S. market. Okay, so what are we doing while the U.S. market is trading? We're sleeping. That's right, we're sleeping. Okay, so 6 or 7 o'clock in the morning, local Queensland time, the stock market in America closes. So you wake up 7 o'clock in the morning, the market's already closed. You go over to your computer sometime during your day, afternoon, evening, morning, doesn't really matter. You download the stock market data to your computer. You look at the chart. How quickly can you tell that there's nothing to do today, that the price is only just sitting on your break-even point? How quickly can you tell that? Like that. So what do you do now? There's nothing to do. In fact, the market's closed. There's really nothing to do. You are forced to do what? Turn the computer off and go where? Outside. You're forced to go do something. There's nothing to do. Who only wants to spend a maximum of 10 to 20 minutes per day maximum on their trading? Okay? But who here trades the Australian stock market? And because the Australian stock market's open while you're awake, who gets tempted to look at it for an hour or 2 hours or 3 hours or 4 hours a day? Right? Now, does your looking at the stock market help the share price go up? No, but it helps you develop a what? I have discovered the single most successful way to trade the stock market is to be unconscious when the market's open. Right? Because if you're not looking at it every second of the day, you're not getting stressed out. Understand, we don't care about the intraday movements. I don't care if oil went up or down $1 or $2 every day, because we're looking at what? Over the longer term. And I've got a put option to hedge it in case it goes down. I don't care, right? People who sit there looking at the market all day, you get stressed out, don't you? Doesn't it make far more sense to identify the longer-term trend, take a good-sized position using leverage, put insurance in place in case you get it wrong, and go to sleep for 5 months? Look at it for 10 seconds a day. In fact, who here owns an iPhone? Right? Who loves their iPhone? All right, they don't understand, do they? Unless you have an iPhone, you just don't understand. Okay, you don't understand how much you can love an inanimate object. This thing is fantastic. People say BlackBerry too, iPhone, right? Why? Because there are programs you can download on this thing for free. I don't even turn my computer on anymore. I literally wake up in bed, market's already closed, I turn this thing on, click one button, and straight away I get all the live prices, the market's already closed, I can see exactly my prices, go, oh, done, nothing to do today, finished. I haven't even got out of bed yet, and I'm finished. There's nothing to do. Most of our trades take months to play out. Day by day, there's literally seconds. Once you're on a trade, it takes seconds a day to look at it. And we do, because where's the best place in the world to do this? To trade the U.S. market? Here. Not only to get the best country in the world, it's the best time zone in the world to trade the U.S. market because it's trading while we're asleep. Where's the worst place in the world to trade the U.S. market? In America. Because they got the same problem we have here trading the Aussie market, right? They're awake when the market's open, so they're tempted to look at it. Fantastic. Okay, so which way do you want the price to go now? Now, hold on, let me just ask again. Which way do you want the crude oil price to go? You do realize that if the crude oil price goes up, the petrol price goes up. You do realize that, right? Okay, so who got upset when the petrol price got really high last year? Okay? Obviously, you didn't have CFDs on oil, correct? The only people who complain about the petrol price are people who don't have CFDs on oil, correct? If you have CFDs on oil, where do you want the petrol price to go? Up to how high? High. Screw everybody else, right? They can go buy CFDs on oil too. Who thought when they came here today, who didn't think when you came here today, you were coming to a seminar to learn that you wanted the petrol price to go up? Right? It just depends what side of the coin you're on, right? What side of the trade you're on. Okay, so which way do you want the price to go now? Up. Let's have a look. Okay, so it went all the way up to 40, back down again. So as of a couple of days ago, it was trading up at about 38, what is it? 39.12 or something. I can't see it from here. Okay, so as of a couple of days ago, it was trading at $39.12. Okay, so it's gone way up now. So now that it's gone up, what's happened to the value of the puts? They've gone down, that's right. So the puts are now worth, how much is that? The puts are now worth $1.55. So we've lost money on the puts. So all up, there's a profit of $14,576, but we've lost $1,260 on the puts. Who's excited about losing money on the puts? Come on, who's excited about losing money on the puts? Why are we excited about losing money on the puts? Because we made more money on the shares, right? We made more money on the trade, right? Simon, you don't want to crash your car, do you? Now, you don't have to hassle the car being smashed and you being dead, God forbid, right? You only bought the car insurance, why? In case you crash the car, correct? It's the same thing here. Which way do you want the price to go? Up. You don't want it to go down. But if it goes up, the put price goes down, correct? But that's okay because we already worked out where the break-even was. It already went through the blue section months ago. Ever since then, we've been in a profit. So every day we've been in a profit. Imagine waking up in the morning, every day you're in a profit, and it's just going up and up and up. How does that feel? How quickly do you want to wake up in the morning to check your phone? All right? How much more money to make that night? All right, take off the interest to date, have a net profit then of $12,266. That's up till right now, right? A total profit then of 255%. So in other words, you got all the put costs paid back, all the interest paid back, and a 255% net return on the investment. And we've still got a couple months to go before the put option expires. Now here's the big question. How high can the oil price go? How high can the share price go? Right? Now we know the oil price got to 148 last year, and the share price got to about 120 last year. Let's say the oil price only gets back to $110, $120 a barrel, not even the high of last year. If the share price gets to about if the oil price gets to 120, the shares will get to about 90. Does that make sense? Because about $30 behind, right? So share price, now look on the graph, you can see that's not even the high of last year. Right? If the share price goes to 90, who feels like kind of missed the boat? Like who wished they got onto this trade back in April this year? Okay, have you missed the boat? Has the oil price already zoomed back to last year's highs? No, in fact, you can get on now. Forget April's price, now's price. Literally now's price. From where it closed a couple of days ago, if you got on the trade on Monday, tomorrow, which is pretty much the same price, gone sideways the last couple of days, if you got into it now's price, and the price of oil got back to 120, and the share price got to 90, right, that would be a rise of about 137%. Take off 10% to cover the cost of the put, leave about 127% on the shares, times 10 for the leverage would be a 1,270% profit. To put that into context, who here would have about $1,000 with which they would be prepared to put on the CFDs for this trade? Okay, if I'm right, and the price of oil goes back to 120, and the shares go to 90, and you got on the trade now, not April now, $1,000 would turn into $12,700. Who would have $10,000 with which they could use to put on the CFDs? Okay, and again, if I'm right, $10,000 would turn into $127,000. For a 2-minute trade, it would take you, and about 10 seconds a day to look at it, over however long it took for the oil price to get back to 120. The last time it went from where it is now, $70 to $100, took 3 months. I'm not saying it will happen that fast again, or whether it will or not, but if I'm right and it goes up, 10 grand would turn into 127,000 net profit. Who here would change their life if they earn 127,000 passive on the side? Now, I'm not suggesting this, but just think about it. Okay, I'm not suggesting it, but a lot of you are a mature audience. How many people here would have some equity in property? You might want, don't have to put your hand up, but you could borrow against the equity to place a trade. I'm not suggesting this, right? But just think about it. If you put $100,000 on this, and I'm right, the $100,000 would turn into $1.27 million. Whose life would totally change? Again, for the exact same 2-minute exercise and 10 seconds a day, if you think the oil price is going to go up, this is, in my opinion, the most powerful way. And remember, you got the put options to protect the trade. Make sense? Show me a more powerful strategy, because I would love to see it for generating wealth in just literally a couple of minutes exercise, seconds a day to monitor it, with downside capital protection and phenomenal leverage if you get it right. In a market that we know the price has already gone to 148 before, and it's currently recovering like that right now. I've been telling people, Rob, back of the room, I've been telling people to buy oil since February this year when it was 32, hasn't I? Every event this year, I've been screaming at people, buy oil. Even though I'm not supposed to give you advice. It's not advice. Buy oil. No. Right? I've been saying it all year, right? Holy smokes, all right? Now, here, have a look, I'm running out of time. Quickly, here's the oil price over the last few years, right? Now you see $75, which is where it roughly is now. Look back at 2007. It has hit $75 in 2006 and 2007, and then it's hit it multiple times. Why? Why is $75 the single most hit price, where the most resistance price? Why has it hit that price so many times? Because $75 is when North American oil becomes viable. Right? And that's a real key price. Now, back in 2007, when it hit $75, it finally broke $75. Within 3 months, it was at 100. And that was at a time when people couldn't believe it was that high. Today, it's right back at $75. It's actually broke 75. It's near 80 at the moment. It's broken 75. I personally believe we are at the beginning of one of the absolute biggest bull markets in the commodity market in the history of the world. Why? Because real estate is still down. And unless banks lend again, real estate's not going to recover. Stock market's starting to recover, but in America, it's a jobless recovery. They have that record high unemployment, and yet the stock market's recovering. So who thinks their stock market recovery is not actually based on growing prosperous wealth? It's actually just a rebound from the drop and the stimulus that they've been doing. Right? They've got a massive unemployment problem. And when that problem rears its head in about 3 to 6 months and inflation starts to rally, I think we're in for a massive stock market crash. So money, when it comes out of markets, has to go somewhere. Typically, historically, it would go into bonds, but the interest rates now are the lowest they've ever been. So where's the only place left to go? Commodities. And I think that we're in for potentially the single biggest commodity boom in the history of the world. And particularly when oil breaks 75, because as oil starts to rally, it pulls all the other commodities up with it. Where's gold right now? Gold is at a record high, hit over $1,200 an ounce. And Rob, for the last 3 years, I've been telling people to buy gold. 2 years ago, if you came and saw me, I told you to buy gold when it was $600 an ounce. Where is it now? And I told people back then, it's going to go to $1,100, $1,200, and no one believed me. Right? How many people here own gold? Well done, Rob. What about silver? Silver is even more exciting. We were buying silver when it was $8. It's now over $19. Right? It's fantastic, right? So we've been talking about this for a long time. You guys just need to sort of get to the program. The benefit you have, though, is that the entire commodity market crashed, and now it's what? It's recovering. You literally have a second opportunity to get on board this thing, because we already know where the price has been before. And with all the other markets suffering, there's one market to go. And when there's huge financial uncertainty, where do people want to put their money? Into physical hard assets, right? Gold, silver, oil, copper, zinc, like physical hard commodities. That's why I personally think we're about to go through the biggest boom in the commodity market ever in the history of the world, and why I can't encourage you enough to think about looking at trading CFDs with put option protection on this, and just follow our lead. We'll show you exactly what trades we're doing. Just piggyback, do the exact same trades with us, and we'll see where we're going to go in the next couple of months. Right? That's what I personally think is going to happen. Okay. Now, so I haven't missed the boat, but I'll tell you this, the boat is leaving the dock. All right? On this particular trip, the boat is going, okay? You're still tethered to the dock, but you're missing it if you don't start picking this up. And let me say to you one also thing. You guys watch the news, right? Channel 7 News, Channel 10 News. Who's noticed that, Channel News, Channel 10 News, whatever, they have about 1 minute of news, 27 minutes of sport, right? And about 30 seconds of finance. But right at the very end of the finance, they tell you the oil price. Correct? Who's noticed that before? Right? They also tell you the gold price, okay? So right now, the oil price is around $75, $80 a barrel. If you now don't do this, and if you watch that, if the oil price goes to $110 a barrel, you will know you've missed out on 1,200% profit. Sorry. So now you know what you didn't know. You were better, if you're not going to do this, you were better off 2 hours ago when you didn't know what you didn't know. Now you know what you didn't know. Now you have to do it. Otherwise, you'll kick yourself if you don't do it. Make sense? Okay. So, and this is also why the Aussie dollar is going up, because the Australian dollar is driven by commodities. Commodities go up, the Aussie dollar goes up. That's why the Aussie dollar has gone from 60 cents to 92 in the last few months, and I personally think it's going to blow through parity within the next 6 months. We'll be above the US dollar within the next 6 months, particularly if the commodities rally strong. All right, now, so the key to success with commodities basically is know the production costs, know the supply and demand, and know who the speculators are who actually drive the prices. And the cool thing about commodities is that when you trade shares, there's hundreds of shares to look at, but when it comes to commodities, we only look at about 6. Right? I personally focus on energy and metals. Okay, so crude oil, natural gas, gold, silver, copper. If you focus on just those two areas, you can learn to make more money than you'll ever need for the rest of your life, because those are the areas that everyone else focuses on. Right? Some people look at the agricultural ones as well, but we just focus mainly on energy and metals. Okay? All right, so short selling quickly. Short selling is the idea of making a profit in a what? Falling market. So just like you can make a profit in a rising market, you also make a profit in a falling market. You don't buy the CFD, you do what we call short sell the CFD. And what's more, you can protect the trade with options. So if you think the market's going to go down, you short sell the CFD and you buy a, not a put, you buy a call option. That's right, you do the exact same trade in reverse. This is exactly what we were doing last year when the whole market was crashing. And then this year we've been doing it on the way up again. Right? So will the commodity market peak and then crash again? Yes. Absolutely. Okay, so you don't just make money in one way, you can make it both ways. And then recognize where that money's going. Okay, now, who has learned more in the last 2 hours than they thought they were going to learn 2 hours ago? Who's been pretty much blown away by what they've learned in the last couple of hours? Who would like to go and do that oil trade? Okay. Now, who's serious about this? I appreciate it. I take this stuff pretty seriously, even though I joke around a bit. I'm pretty serious about what I do, very professional at what I do. I teach people how to do this professionally so they can do this for themselves, not just to play at it as a hobby, but actually turn themselves into successful traders. Who would like to do that? Actually have trading as one of the main sources of their income and their wealth creation. Okay, now I'm going to teach you in just a moment the program that I'm going to offer you. But if you come and do that program, I'll just mention now, I do offer another level beyond that, which is called my elite coaching. I'm not going to talk about it today. Right? You learn about it when you come to my program, which I'll tell you about in just a second. But just to let you know, the elite coaching program, that's for people who are super serious, that they want to focus about 5 to 10 hours a week personally training with me for a whole year. So 5 to 10 hours a week, me as your personal coach for an entire year. I teach you absolutely everything I know about everything about trading. Futures, currencies, stocks, options, CFDs, US market, global finance, the lot. Okay? It's well beyond what I'm going to teach you from this program. However, what I want to share with you is I started that program back in April this year, March, April this year, for the very first time. We only take about 70 people per year into the program. Now, I started the program back in March, April this year, and I took $100,000 in an account, and I've been using that account as a demo account, sort of a demonstration account, for the last 8 months. Now, that particular account grew from $100,000, and by October this year was at $1.2 million. Okay, so again, I'm not trying to just brag, I'm just showing you that in a 6-month time period this year, that one account that I've been using, and all these are documented trades, all with my elite clients, we made over 1,200% profit. Now here's the kicker. We only ever used $20,000 of the 100. So really I turned $20,000 into $1.2 million